I was having a conversation with a business owner. I think it was last week, and he's kind of starting the process of thinking of selling. Think now's the right time. So, a typical conversation that we have. We want to understand why he's calling us, what's motivating his sale, what his goals and objectives are. We're explaining our process, how we do things, and then he asked me a very interesting question. Hi, everybody. My name is Keith, President of Osage Advisors. Welcome back to our podcast, The Ins and Outs in Selling a Business. So it was a question I haven't had many times over my 24 years plus, and he asked me this question, and I think it was a great question. He said, "When should I expect the unexpected?" I kind of sat back and I said, "Well, you have about 6 hours because you never know what you don't know until you start getting ready to sell your business, go through a process." So I thought about it for a little bit, and I kind of broke it up into like 4 buckets. Because the answer is you could expect the unexpected at any time. Before you sell, during you sell, during when you're looking to close, and then after you sell, right? So I kind of broke it up into like 4 buckets. Bucket number 1 is, when you're thinking of selling before the sale. And bucket number 2 is, during the sales process, things come up, right? Bucket number 3 is kind of like, post-sell, you have a deal, right? You're in due diligence. And you're going through the legal, the financial, multiple phases of due diligence. And then bucket number 4 is post-closing. Because there's always things that have to be tied down and trued up, as they call in the trade, once the deal is done. Typically between 30 and 90 days. And then you have escrows for any, let's say, indemnifications or warranties, misrepresentations, whatever you want to call it, that there's money sitting there that is your money you get once that 1 to 2 year timeline elapses. So I thought we'd kind of go through it. There's probably going to be a couple episodes here because there's a lot to go through. Like I said, I can talk about this all day long. And, before the sale, I think the unexpected is why you're likely calling us in a number of reasons. Is we work with family closely held companies. That's our main bread and butter. I've been doing it we're in our 25th year now. And you get the surprise, unexpected, that you thought your son or daughter wanted to take over the business. And they come to you and said, "I don't want to take over the business." And so you're sitting there and all of a sudden it's like, and it could be various reasons, right? If you're 100% owner, it's one thing. Maybe they don't have that same ability to take that risk, to be entrepreneurial, to be multitasking. Like you wear 20 hats a day, right? And they are feeling a function, and they see you, not only during the day, but they see you at night. They see you on weekends. They see you at holidays, and they say, I don't want this. I want to stay with the business. I like the business, but I don't want that responsibility, that added responsibility of people looking to me as a business owner, like your employees look to you to steer the ship because you're providing for their livelihood. That's a huge responsibility. So it's not uncommon that a family member, like a son or daughter, will say, "I don't want it." And 2, you may be in a position at this point where you can't just turn it over to them and have them pay out over time. You need some money up front, right? You need the cash out, a portion of it. You're happy to provide a seller, family-friendly seller note, have them pay over time, but you need a certain amount of money so you and your spouse or yourself, whatever, could live your lifestyle like you live today and provide for your retirement. You can't put it all at risk when you transition to a family member like your son, and they may not be in a position where they want to sign, personally guarantee a note. We had that happen. We had a deal ready to go, and he said, stop, my son wants to buy me out. And in 9 months, he came back and said, my son doesn't want to personally guarantee the loan, so let's sell the company. And his son stayed. He was CEO for a couple, 3 years after we sold it with the buyer, and worked out great. But that's the first big unexpected, right? Which is hard to deal with a lot of times because it's really emotional. It's your family, right? So it's a really emotional decision to say, okay, well, I got to take an alternative path. And that's like looking for an outside buyer, which again is unexpected after all these years of your family being into business. And you may be second generation versus first, and you're thinking third generation is going to take it, right? What was the statistics? I think it was something like 26% of businesses, I could be off a couple of points, transition from first to second generation. And then going to third generations, it drops in half to like 12 or 13%. I mean, I'm probably off a little bit on the percentages, but it's a significant drop off, right? From A to B to C. So that's the first hurdle. That's the first unexpected thing, is why we're having this conversation. And I've had it. In fact, the conversation I had last week with this buyer is like, my daughter doesn't want it. She likes working there, but she doesn't want to run it. She doesn't want the responsibility. Another thing is what I call value expectations. What's the market value for my company? You can get every professional valuation in the world, but that's not market. That's for a specific purpose. That's for estate planning. That's for gifting. That's for buy sell. That's for buyout between partners. But that's a valuation based on specific information where the market could be different, could be changing, could be a buyer out there who sees a lot of intrinsic value and they're willing to pay above market. So understanding that value expectation is paramount. And we've had clients that come to us. And by the way, we do not take on a client without doing what we call our current market valuation assessment. It's not a certified valuation, but it's based on our experience, based on a number of aspects in what we see in deals and trading ranges, published and non-published. We get after almost 25 years or close, we get a good sense of what the company will trade for. So, and you may be at, dinner with a friend who sold his or her company for, $20 million. And there's, about the same sales volume, about the same profitability, but they're in a whole different industry, right? They're trading of multiple revenues. You're trading of multiple profits. It's not apples and apples. It's apples and oranges. So getting to that aspect of, okay, what's my company worth? And then you sit with us and we go through it and we go detail. We'll go through 5 or 6 gyrations and triangulate. And we'll say, okay, based on this, you'll likely give you a trading range of X to Y. And, I think we're very good at that. We always like surprises. But all of a sudden you realize, geez, I thought it was worth this. And it could be worth that, but you need to stay on for a couple more years and build your sales and build your profits to get to that level. So understanding that valuation expectation, is something that to align so when you go to market that you're in that range of where the company will likely trade based on current economic and M&A environment. So if you're not, again, and then I had a conversation I got an email from a great guy. He said, look, not an email, voicemail. And he said, I'm ready. I've been doing this for 35 years and I just had it, right? I'm ready to. So we got on the phone, we talked, signed a CA. He sent me his numbers. We did our internal value. And I said, look, based on this, you're likely traded between X and Y. And he says, yeah, you're probably right, but I can't sell for that. I said, okay. So I said, well, are you you sounded like you're exhausted. You wanted to sell, but I said, well, you're gonna have to build it back up, right? Or find an alternative way of transitioning your business, but maybe hiring someone to run it. You keep it. What I mean, there's a million things you can do. But again, he expected that, but he didn't want to didn't want to really hear it. He was hoping that we would come up with a bigger number and he'd be excited. So, right. So, family member not interested or not willing to take on that additional responsibility, understanding the value of your business. These are all before sale. I think the other aspect is getting your house in order. And my son says this all the time. Number one is get your house in order, right? Your financials is that when you have, say you're a smaller company, right? You may have a controller. He or she's been with you for many years. You do internal accounting. You don't have a CPA. Is to make sure that you are stress testing your financials so that there's no surprises when you get into the next phase of selling your business. And you'd be surprised how many people you come up and you ask the question. And the number one question that we always ask, mainly for manufacturers, distributors, is how do you maintain your inventory? What systems do you use? How do you account for it? Do you use cycle counts, annual counts, monthly counts? And how do you, what's your obsolescence policy, slow moving policy? These are all things that come up. And the answer is that a lot of people kind of are, say they're not as precise or exact they should be with inventory. And so when they look at their inventory and they realize that there were some significant discrepancies between what's on the books, what's in your shelves, right? Or on the floor, that could shift the profitability of your business significantly. That wasn't expected. So what do you have to do then? Then you have to kind of like clean it up, figure it out, update your financials. Those are kind of things, those are unexpected. I mean, in the back of your mind, you probably know inventory's kind of okay, but I'm not exactly sure the exact number or reasonable number. But I mean, from a financial perspective, that, in that first, like before the sale, get your house in order. I mean, from a manufacturer inventory. And I think one of the other things that we don't talk a lot about, but is have your lawyers do a deep dive into your corporate records, right? We had a client once that we signed, about to sign up, and they hadn't registered with the state in 5 years. It's not big. It's like $20 a year, right? So they're really registered. Their stock certificates weren't signed by their owners. So you want to have your lawyers go in and really do a deep pre-due diligence on your legal, your bylaws, operating agreements, your stock certificates, your filings, do a lien search. Even though you paid off something 20 years ago, the bank forgot to release the lien on it. And then that causes, issues when you get into a deal that they get that cleaned up. Because the banker you talked to 20 years ago, that bank may not be around anymore. They may have sold to somebody else and somebody else and somebody else. You can get it figured out, but all of a sudden it just adds a level of stress and additional cost. So those are kind of things like, before the sale, unexpected things that pop up. And I'm not even the tip of the iceberg here, but I'm trying to give you some highlights of what I think are some things to think about. And then we get to the second bucket is kind of like, during the sale. And, some things pop up like tariffs, common thing right now, right? I mean, it's all over the place. I mean, we have, how do tariffs affect your business? How's your supply chain affected? You're in a sales process, and then all of a sudden, the next thing you know, your main supplier overseas has got hit with 100% tariff. And how's that affect your business? The buyer's going to sit back and hit the brakes. You may not be affected, by the way. I'm saying this actually came up in one deal we're working on. We pulled it because of this, and frankly, we're in a much better position now, 6 months later. And as I said, the game is always about patience when you're selling. Never rush, always patient. But you put the brakes on the buyer place because some geopolitical issue popped up that no one could foresee. Unexpected. We had a situation where our client was highly relying on two major customers in manufacturing, and we're deep. I mean, we're literally a month away from closing. We've set the date. We're at the point where, we're starting to open up and set up calls with our customers, let them know what we're doing with the buyer on the phone. So there's a transition. They get, and most customers are fine with that. They expect it. They just want to make sure that you're being taken care of on time, delivery, high quality, etc. Our client gets a call that their number two customer says, look, we're going to take this big piece of business and we're putting a 6-month delay on it. You got to communicate that to the buyer. It's required. If you don't, you're putting yourself at legal exposure. And so here we had a client we've been dealing with, main customer for 30 years, and all of a sudden they say, hey, we're going to delay our orders because we're uncertain about the economy, and so we're going to push that out 6 months. That's unexpected. I mean, you've never had that happen with this client before, this customer before, but it pops up. So you got to find a resolution to that. Either you stop the process or you work with the buyer to find some kind of structure that maybe you get paid out when that client starts accepting orders again, and you start billing them and they start paying you, which in this case is what we did. We kind of put it to what we call an earn-out, structured payment, and it worked out great for our client. But it kind of caused a lot of unexpected anxiety, right? It was like all of a sudden everybody's like, how are we going to deal with this? And if you have a good working relationship with the buyer, willing buyer, willing seller, you will find a medium ground that works for you. And if you don't, you step back and say, okay, look, we'll come back to us in 6 months and we'll reconvene our conversation, or you may go back to market and find a different buyer. But it's unexpected that this is coming up when you didn't anticipate it. Another thing could really happen is and we don't do this because we run a full process. We want multiple buyers at the table. But if you're in a proprietary situation and you're dealing with one buyer and you haven't really talked to anybody else, do you really know that buyer, right? I mean, do they have the capabilities doing deal? Do they have the financing? They may have a partner in an equity fund that say, yeah, we'll do the deal with you. And then that fund decides we got a higher priority. We can't do it right now. We want to wait 6 months. So the buyer all of a sudden starts sending signals to you that, hey, they start slowing things down. You thought everything was going great, and all of a sudden, it got quiet. Whether it's the financing, whether it's a financial backer, whether it's them as a buyer who's never done a deal before getting nervous. Said, like, I'm not sure I want to sign on this loan. I'm not sure this is the right deal for me. I was really I wanted to always buy a business. And there they are, deep into it. And the next thing you know is that it got real quiet. And all of a sudden they kind of like are fading into the wood, the hallway. And you're like, I didn't expect that. I thought we had a deal. I thought we were in good terms. Everything was great until like Tuesday. It's now, and they just disappeared. And then also, so those are like, I can go on and on and on about, before the sale and during the sale, but I just want to give you a lot of highlights. So we're going to kind of take a pause right now, and we're going to pick this up in another episode because it's important to talk about the aspects of after you signed LOI, during the closing process and the due diligence process, and of course after the sale. So again, my name is kdee. I'm president of Osage Advisors. Thank you for being with us today. If you enjoyed our podcast, please feel free to subscribe at our YouTube channel, The Ins and Outs of Selling a Business. To learn more about Osage Advisors, you can visit our website at osageadvisors.com. If you have any questions, please feel free to email me at kdee@osageadvisors.com, or pick up the phone and give me a call at 860-767-3273, extension 1001. Thanks again for being with us today, and have a great day.